Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Wednesday, the 25th of June, 2025. So as usual, before we kickstart today's gist of the Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we kickstart the most interesting segment of the daily dose, which is the intraday technical outlook on those broad-based cross-asset classes, let's have a quick recap what has taken shape yesterday, early this morning in terms of news flow, economic data releases, as well as their respective impact on the various intraday movement on these broad-based cross-asset classes. So yesterday was broadly a risk-on day for global equities. Why? Because due to the US President Trump brokered ceasefire deal between Iran and Israel that has this mini conflict war that kickstarted since 13th of June, which lasted for 12 days. So yesterday, after Trump announced that there's a ceasefire deal that has more or less been agreed upon these two countries in early Asia session yesterday, we start to see a throughout risk-on rally in the broad-based global equity market over here. So despite the fact that both sides has kind of show a bit of tension in the European session yesterday, but apparently this tension has starts to die off as the UN nuclear watchdog is now urging a rapid resumption of inspection at the Iranian atomic sites over here. So also we got to respect the positive price action of yesterday's movement, and also yesterday movement also lead to a slump in global oil prices. So let's share global oil prices has a big swing, especially the West Texas crude oil in the last 2 days. So they actually dramatically went up by 10% and so went down by 13% or so. So it's a wild swing. So given this wild swing in oil prices, and oil prices right now is below the $70 US dollar per barrel, that also reduces stagflation risk, which is a bit of an encouraging sign for the global economy, especially in the US. So that actually could allow the Fed to kickstart its interest rate cut cycle again, where market is expecting it to come in the September FOMC meeting. So that created a bit of a liquidity uptick rather than a liquidity squeeze in the US financial system. So that also created a positive feedback loop into the US stock market. So what you could see over here is that the US stock market and even the global stock market actually rallied on this risk-on upbeat mood by the reduction of oil prices, leading to a reduction in global geopolitical risk premium, leading to a reduction of stagflation risk. So throughout the US session, the stock market actually rallied very strongly and closed near the session high. So the SPX is up by 1.11%. The higher beta Nasdaq 100 is the top performer yesterday among the 4 major US stock indices, up by 1.53%. And it also kind of retests the current all-time high level at around the 22,250 mark. The Dow Jones Industrial Average up by also 1%, 1.2% by, and the Russell 2000 up by 1.3% over here. And if you were to look at from the perspective of the FX market, so on the FX market, the initial dollar strength driven by the rising geopolitical tension that was seen last week in the Middle East starts to actually reverse to the downside. So if we look at the 5-day rolling performance of the dollar right now, it starts to actually trend downwards. So the dollar now is the weakest against the Swiss franc, the sterling, and against the euro. Okay, based on the 5-day rolling performance basis, the dollar, the euro is actually down. The dollar is down by 1.15% against the euro, down by 1.4% against the sterling, and down by 1.6% against the Swiss franc, whereas the dollar index is trading down by negative 1%. And if you look at the technical chart of the US dollar index, so that will give us a brief a gauge of whether the dollar is strengthening or weakening. So this US dollar index, if you could look at it over here, very interestingly, there's a bearish reaction of the 20-day and the 50-day moving average. All right, over here. All right, we could see. So this bearish engulfing candle. So that took shape on this Monday. And yesterday, the weakness further exacerbated to the downside. So what we could see is that the dollar is now threatening to break below the low of 12th of June 2025. And this low level is in fact confluence with a very key technical element, which is at 97.40, a major support level, which is this long-term ascending channel from May. Okay, give me a minute. Okay, May 2011 low, right? So that's about what 40 close to about 14 years ago, right? So with a breakdown below 97.4, that could potentially see the start of a major downtrend in the US dollar, because right now it's still trading within a medium-term downtrend, still holding above the key long-term circular support of 97.40. So if it really starts to break down below it, and that could potentially kickstart a major downtrend phase for the US dollar, means i.e. breaking down below its longer term circular ascending channel support that is running since May 2011 low. So that's close to about what, a 13-year cycle or so. All right, so that could be a pretty significant movement on the US dollar that could actually take shape this week, if we could have a weekly close below 97.40. All right, because if you look at the current weekly candlestick, is also pretty much of a bearish Marubozu candlestick that is forming right now after the retest of the 20-day and the 50-day moving average that the price action of the bulls can't surpass. All right, so a pretty much important, significant observation on the US dollar that I would like to share with you guys over here. And also, very interestingly, with that US dollar strength that came back in the US dollar's bearish reversal, I would say that means the eradication of the US dollar strength that was seen early last week, and now the bears has now starts to take a foothold on the US dollar. That means talk about US dollar weakness. So with this US dollar weakness, very interestingly, gold price managed to actually stage a rebound as we are speaking right now. So let me share with you the movement of the gold, right? So we know that gold price yesterday tumbled downwards, and on the intraday basis broke below that key near-term support level at 3,350, which is the 20-day moving average. But very interestingly, the movement of this sell-off in gold price is likely driven to short-term speculators unwinding of their net long position, because the 20-day moving average provide that buy the dip mentality. And due to yesterday's sudden news flow, where the US President Trump announced that he managed to actually broker a ceasefire deal between Israel and Iran. So that causes the sell-off in the gold yesterday, the intraday sell-off, all right, over here, okay, below the 20-day moving average, right at around the 3,350 mark. So this 20-day moving average has been producing a good near-term support level since 21st of May, where it reintegrate above it. So every time it tested this 20-day moving average, there could be buying the dips at price action movement that came into the market. So this sudden breach down on the 20-day moving average could potentially lead to a stop loss level that's being triggered by short-term speculators. But however, in early today's Asia session, price action starts to turn positive by inching upwards by 0.2%. And in fact, yesterday, price action also managed to trim some of its intraday losses and managed to actually close right exactly at the 50-day moving average, which is at around this 3,320 level over here. All right, so it seems to us that there is some support that's being formed in gold price yesterday, despite that earlier sell-off where we see the potential trigger of stop loss level being triggered after the breach of that 3,350 level. So one of the reasons why gold is being supported right now is due to also the dollar weakness as well, the US dollar weakness, and also on top of that, yesterday we have this Fed Chair Powell first day of his semi-annual testimony to Congress. So yesterday he has this testimony where he actually answered Q&A question with a House committee yesterday. So during this Q&A question over here, US the Federal Reserve Chair Powell reiterated that policymakers need not rush to adjust policy despite President Trump demands and some Fed governor opponents to lower interest rates soon. So what do I mean by this? Because if we were to look at last week or so, there are two Federal Reserve governors or officials, which is Christopher Wheeler and as well Michelle Bowman. So Michelle Bowman tends to be a more of hawkish voice, and surprisingly, these two Fed officials, Wheeler and Bowman, signal that they will be open to lowering rates as soon as July over here. So based on the speech that and the Q&A session that Fed Chair Powell gave to the members of the Congress yesterday, which is the House committee, is stating that nothing really changed from last week FOMC post FOMC press conference, where he tends to favor more of a wait and see approach. But however, there's the little statement that he made that if it turns out that inflation pressure do remain contained, then we could get to a place where we cut rates sooner rather than later. So this is a kind of a indirect response stating that Fed Chair Powell is actually open to cutting rates sooner than what market is being priced in the CME Fed Watch 2, where they still expect the first interest rate cut by the Fed to come in September rather than July. So how do I find out that? By looking at the CME Fed Watch 2 over here. So this CME Fed Watch 2 at this point in time, which is being compiled by CME, the exchange, based on the latest price data from the Fed Funds futures contract market. So that actually imply the kind of a expectation by the Fed Funds rate futures traders expectation. So still high at 81%, where the Fed Funds futures market traders are still expecting the Fed to stand pat in the July meeting, 4.25% to 4.5%, despite that two Federal Reserve officials, Wheeler and Bowman, are in favor of cutting rates as soon as July. So on the 30th of July, still stand pat. But what's interesting, if you look at the aggregated probability, the second rate cut is likely to come in much earlier than what market initially penciled in right after last week FOMC meeting. So right after FOMC meeting, market is looking at a high chance of the first cut to come in September, but the second cut will potentially come in the December meeting, which is 10th of December. But right now, we have a high chance of 65% that the second cut may come in on October instead, on the 29th of October 2025 FOMC meeting. So the second rate cut is bring forward. All right. And one of the reasons why this second rate cut is being bring forward, because yesterday we do have a key US tier 1 economic data, which is considered as a soft data rather than hard data. So that is considered a leading indicator, because that actually measures the consumer sentiment in the US that potentially will have a leading kind of element ahead of the actual consumer spending or retail sales that will starts to actually report in the next few months. So consumer confidence in the US as being calculated by conference board. So there are actually two consumer sentiment or consumer data confidence data that market watchers tends to watch to give them a bit of a leading element on how well or potentially how well consumer retail sales will be affected. Why this is important? Because 3/4 of US economic growth is driven by the services sector, and the services sector comprises of retail spending. So consumer confidence or consumer sentiment, there are two key data. One is the University of Michigan that was released 2 weeks ago, and this one was done by the conference board. All right, so the conference board consumer confidence data actually slipped below market expectation. Market expecting a recovery to 100, it went down to 93, and even the 98.4 was printed in the month of May. So if you go to the conference board website over here and you take a look at their the chart, you can actually take a look at read the snippets of it. So consumer confidence retreats in June. So what you could see over here is that it continues to print lower over here. So indicating that potentially consumer spending and retail sales will be rather on the weaker side, rather than the stronger side, or even potentially lead to a slowdown in the US economic growth in the next few quarters, because this is a leading data. So that also actually explained to us that we now start to see softness in leading US economic tier 1 data, this soft data, and that could also alter the mindset of some of the US Federal Reserve officials to be less hawkish and more skewed towards the dovish side, and that potentially also reduce the long-term US Treasury yield as well. So if you look at the long-term US Treasury yield, the 30-year yesterday continues to slip down below the 20-day and the 50-day moving average, and the 10-year US Treasury yield also continues to slip lower below the 20 and the 50-day moving average, and now attempting to break below the 200-day moving average. So that also potentially lead to lower yield, which imply potentially lower interest rate costs in the US. And we know that gold itself is a non-interest income asset. That means when you hold gold, you don't receive interest rate income. And with longer term interest rate in the US as being a kind of a portray by the long-term US Treasury yield, that could potentially imply holding gold, it will lead to lower opportunity costs. So that also explains why gold price rose yesterday, managed to find support at the 50-day moving average after that initial sell-off, and managed to close higher in managed to actually open higher in today's Asia session. Okay, later I'll touch on more about the intraday technical outlook on gold. All right, so one of the things that we got to be mindful over here is that we know that Trump and his administration has been pretty much in the limelight over the weekend, stating that they managed to successfully delay Iran ambitious of enriching nuclear by a couple of years now. That is because the US bombing of the 3 key Iranian nuclear enrichment sites. So yesterday there was actually some analytical evidence from the Pentagon Defense Intelligence Agency reporting that the weekend bombing likely didn't cripple the core components of Iran program below ground. All right, so what it means that the American airstrikes has limited impact on Iranian nuclear program. All right, so something to bear in mind for. So that may not be so peaceful to Israel. So the reason why Israel attacked Iran on 13th of June is due to the threat of this nuclear program. And what US did over the weekend, they are trying to actually indirectly help Israel to actually destroy this or damage this key Iran nuclear enrichment facility by not allowing Iran to actually develop nuclear weapons as soon as possible, and they kind of delayed their development. But instead, the bombing, as portrayed by Trump earlier on, saying that Iranian nuclear research plans or development will be delayed by years. But instead, it seems to me that the damage, the attack by the bombing done by US did minimum damage to the nuclear enrichment facilities. All right, so that may not be so pleased to Israel, and we got to be mindful that what if Israel decided to re-attack Iran back again, right? So to me, the geopolitical risk premium has not been totally eradicated 100%, and things could change as we head into this weekend. So something to be mindful about as well. All right, so with that, now let us now have a quick look at the let us now dive deeper, I would say, into the second segment of today's daily dose, which is the intraday technical outlook, starting with the FX market. So with that, let me expand my screen. All right, so let's start with the FX market. So like I mentioned earlier, right now we are seeing the dollar weakness prevailing, coming back into the FX market, and with the dollar index at risk of kickstarting a major downtrend if we have a weekly close below that 97.4 level. So let us now take a look at the euro dollar. So the euro dollar rallied as expected, cleared above our first resistance, which is 116.10, and managed to find support right exactly at the start of today's Asia session. So with that positive development, we will slowly moving forward, tighten higher the short-term pivotal support for today on the euro dollar, and maintain our intraday trend bullish bias with a tightened short-term pivotal support at 115.70 for today, which is very close to yesterday's European session low and the start of the US session low as well. And if you do the Fibo retracement of this ongoing impulsive upmove sequence, the minor time frame starting from this Monday all the way up to yesterday's US session high, that is the 38.2% Fibo retracement. So as long as any potential minor pullback didn't surpass below 115.70, tighten short-term pivotal support for today, we will maintain our intraday trend bullish bias on the euro dollar. Next resistance level to watch 116.60/1690. Above it exposes 117.25, 117.50, which is a Fibo extension cluster, and the upper limit of this medium-term ascending channel that is in place since 13th of May 2025 low. However, if price action starts a bearish breakdown with an hourly close below 115.70, then today's intraday bullish bias will be negated to kickstart another round of minor corrective decline sequence. First resistance to watch 115.50, a breakdown below 115.50 sees a deeper minor corrective pullback, retesting the 20-day moving average at 114.60, 114.40. We also confluence very closely to the lower limit of this medium-term ascending channel that is still intact or in play, I would say. So that's for the euro dollar, maintaining our intraday trend bullish bias with a tightened key short-term pivotal support for today at 115.70. Next up will be the sterling dollar. So the sterling dollar also rallied, hit our first resistance level at 136.40 before trading sideways in the entire second half of the US session. So with that, we will tighten our short-term pivotal support level to be at 135.70 for today, maintaining our intraday trend bullish bias on the sterling dollar. Above 136.40 exposes 137 figure level, followed by 137.50 level over here. However, if price action starts to do a bearish breakdown below the tightened short-term pivotal support at 135.70, then that could potentially kickstart a minor corrective decline sequence to retrace this very strong impulsive up move that has taken shape since the low of this Monday. All right, so it's like a one-way vertical push up. So that is the 38.2% Fibo retracement that also corresponds with the 20-day moving average. All right, so if the price action starts to actually dip down below 135.70 and manage to find some support at 135.30, which confluence with the rising 20-day moving average as well, so that could potentially see another round of bullish impulsive up move. So I'll be watching very closely at 135.30. Is there any formation of bullish reversal candlesticks at the lower time frame chart, at the 15-minute chart? However, However, if 135.30 didn't hold and break down further, that could potentially see a much more deeper minor corrective decline sequence to expose the next near-term support level at 134.50. All right, so from a better risk management perspective, I would tighten my short-term pivotal support level for now at 135.70, maintain my intraday trend bullish bias. Above 136.40 exposes 137 figure, followed by 137.50 on the sterling dollar, and 137 figure and 137.50 confluence with the 0.382 Fibo extension taken all the way from the low of 7th of April. And if you go to the daily time frame chart, that is actually close to 2022 swing high area. So that's about 3 years from 3 years ago resistance level. All right, so this level here is actually the minor swing high area of 13th of January, which is the 137 figure level, and 137.50 level. All right, this over here, 13th of January 2022. All right, so that's for the sterling dollar. Next up will be the Asia Pacific currency against the US dollar. Okay, starting with the Aussie dollar over here. Let me go through the Aussie dollar. All right, here's the Aussie dollar. So the Aussie dollar continues to actually trade up higher over here. There's actually a bullish U-turn, what we could see over here, right exactly at the retest of the 20-day moving average. So yesterday we have a pivotal support level at 65.55 slash 64.40 level. Okay, let me put it. This should be the 1 hour time frame chart. So yesterday I do a bit of adjustment. All right, so with that in mind, we would still maintain our bullish bias over here, but given this potential curvature, bullish curvature that's being seen right exactly at the 20-day moving average, I would tighten my short-term pivotal support for today for a better risk management perspective. Okay, over here. Okay, which is at give me a minute. Let me do the adjustment again. Okay, 64.80. 64.80. So that will be my Titan short-term pivotal support level, 64.80, 0.6480. Let me do it. Okay, right. So this will be the normal second resist support level to watch. Oops. Okay, so 64.80 Titan short-term pivotal support level, which is the bounce off the 20-day moving average, and also the hourly RSI managed to stage a bounce off the 50 level above, right exactly at the 50 level mark, and also broken below the former parallel descending trendline resistance that previously saw a series of lower high. All right, so there's a bullish breakout above this, stating the return of bullish momentum after yesterday's minor pullback that has taken shape at the start of the US session that lasted into early Asia session today. So first we support Titan short-term pivotal support 64.80, maintain my bullish bias within this still complex range configuration that's still in place since 24th of April, with the key range top or resistance at 65.37, 65.45. A breakout above 65.45 will trigger a bullish breakout from this 8-week plus of sideways range configuration, seeing the next resistance coming in first step at 65.65 over here, 65. 6565. Okay, yeah, 6565, followed by 66 psychological level, which is the 11th of November 2024 swing high and the 0.764 Fibo extension taken from the low of this Monday, and the 6565 confluence with this congestion area here of 11 of November, right? This minor congestion area. Only a bearish breakdown and an hourly close below 64.80, then that would negate the bullish bias and see it slipping downwards towards the middle part of this complex sideways range configuration. Next support level to ponder or to watch will be at 64.50/66.40, which is confluencing with the 50-day and the 200-day moving average. All right, so that's for the Aussie dollar, maintaining my intraday bullish bias within this sideways range configuration, with a tightened short-term pivotal support at the 20-day moving average at 64.80. Next up will be the dollar yen over here. So the dollar yen plummeted as expected over here, and now looking to retest our first support that we highlighted yesterday at 144.50 level. All right, so given this so-called bearish reaction in today's Asia session, which is a spinning top right over here, so confluence with the spinning top high that's been seen at the start of the US session yesterday as well, which is at a 145.20. So using a very tight short-term pivotal resistance level at 145.20 to maintain our intraday bearish bias of this dollar yen that is still evolving within this complex sideways range configuration since the low of 27th of May over here. So with that tightened short-term pivotal resistance level 145.20, bearish bias maintained, breakdown below 145.50 exposes 143.90 and even 143 figure level, which is the lower limit of this sideways range configuration. Only hourly close and a bullish push up above 145.20 will invalidate today's bearish bias to see a squeeze up to retest the upper limit of this sideways range configuration again, with the first resistance at 146.25 followed by 147.15 next. Right, so this one will be 146.25. All right, so that's for the dollar yen, maintaining my bearish bias using a tightened short-term resistance at 145.20. Next up. All right, so that's also sum up the intraday technical outlook in the FX market, concentrating on the major US dollar pair. So now let us now turn our attention towards the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 continues to squeeze up over here and hit our almost hit our resistance level that we highlighted, 24,490. So with the hourly RSI now at the overbought level, but there is no clear bearish divergence so far. But with it coming at the overbought level, there could be a risk of a minor pullback taking shape in the second half of today's Asia session. So first support level to watch will be 24,240. Below it may expose the tightened short-term pivotal support level that I highlighted at 23,880, which is the the confluence with the low of this Marabuzu bullish candlestick that has been formed on the 24th of June, yesterday's first hour of the Hong Kong stock market opening. All right, so I will have a very tight short-term pivotal support for today at 23,880. So I'll be still maintaining my bullish bias in any dips over here, because potentially there could be a pullback. So after this pullback potentially ends, I'll be watching out for any sign of a bullish reversal candlestick forming around this tightened short-term pivotal support at 23,880 to maintain my intraday trend bullish bias on the Hong Kong 33. Above 24,490 sees the next resistance coming in at 24,850, which confluence with the upper limit of this ongoing minor ascending channel that I drew from the low of 2nd of June, and as well as this medium-term swing high of 19th of March. Only a bearish breakdown below 23,880 negate my bullish bias to trigger off a much deeper corrective minor pullback, exposing the next near-term support zone at 23,690, 23,560. Below it, see a retest on the minor swing low of last Friday at 23,260. That also confluence with the lower limit of this minor ascending channel from the low of 2nd of June. So that's for the Hong Kong 33. Next up will be the Japan 225. So Japan 225, yesterday we do have a bearish bias within a range where we expect it to actually slip down much lower to retest the 20-day and the 200-day moving average, which is confluence with the lower limit of this ongoing minor ascending triangle range configuration that is still in play since 13th of May. But the hourly RSI has started to turn rather bullish since the low of since 23rd of June, which is Monday. It has been tracing out a series of higher low over here. Hasn't hit the overbought level yet. Okay, it did hit the overbought level so far. So that being in mind, it could be a build-up of upside momentum where potentially we right now may witness the imminent bullish potential, the potential imminent bullish breakout of this sideways range, sideways triangle, sideways ascending triangle range configuration in the since 13th of May. So that's about close to about a month of consolidation. So with that, I do not want to put Titan short-term pivotal support level to be so tight at 38,600 because price action hasn't clearly broken out above 38,850. I will maintain it my pivotal support zone, which is the 20-day and the 200-day moving average at 38,145 / 38,0350. So I will flip to a intraday bullish bias for today in anticipation of this imminent bullish breakout of the Japan 225, which represents Nikkei 225, due to the positive observation that I explained to you guys earlier on the hourly RSI. So unless we have a bullish breakout that's being seen in the second half of the Asia session today above 38,850, then I would tighten my short-term pivotal support level to 38,600. After 38,850, the next resistance to watch out for will be 39,560, which is a one-time Fibo extension taken from the low of 13th of June and also confluence with the 0.38 Fibo extension taken from the low of 7th of April and also confluencing with the minor swing high area of 13th of February and 14th of February this year. Only a bearish breakdown below 38,0350 will invalidate today's intraday bullish bias to see choppy corrective decline sequence exposing 37,820. Below it sees 37,270, which is confluencing also with the 50-day moving average. So that's for the Japan 225, flipping to a intraday bullish bias stance in anticipation of an imminent bullish breakout above 38,850. So that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 continues to push up as expected and almost hit our first resistance level at 23,880, which confluence with the 20-day moving average as well. So the hourly RSI, there is no signs of a bearish divergence as price action continues to see higher high over here. And right now it has just a so-called exit from the overbought level. So there could be some sign of a minor pullback taking shape during the start of the European session. So with that, I would tighten my short-term pivotal support level to a zone which correspond to the gap up that is being seen on Tuesday at 23,510 and 23,440, which is the former minor swing high area of 18th of June and 20th of June. So using this tightened pivotal support zone, maintain my intraday trend bullish bias on the Germany 30, representing the German DAX above 23,880, exposes the next near-term resistance at 24,110, which is defined by the minor swing high area of 10th of June and 11th of June, and also confluenced by a Fibo extension level linking the lows of 20th of June, which is the, okay, let me share you, close to the 2.618 Fibo extension. All right, over here. However, if we start to see a price action breakdown below 23,440 and the hourly close below it, then the minor pullback may start to evolve into a deeper minor pullback, retesting the 50-day moving average at 23,280, which will correspond with this former minor descending channel resistance now turns into a pullback support at also 23,280. Right, so that's for the Germany 30, maintaining my intraday trend bullish bias with a tightened short-term pivotal support zone at 23,510, 23,440. Next up will be the major US stock indices. So starting with the US Wall Street 30, which is i.e. the Dow Jones Industrial Average. So yesterday price action squeezed up as expected, hit our resistance level. And what's interesting, the hourly RSI has already hit the overbought level over here. And given that this resistance level is being confluenced by two different elements, firstly is the 0.764 Fibo extension that I drew from the low of 23rd of May, and also the upper limit of this so-called potential ascending wedge configuration that is forming on the US Wall Street 30. So with that, there could be some sign of a potential minor pullback taking shape on the US Wall Street 30 for today. So I will flip to a bearish bias for today in anticipation of this pullback that could be formed during the European and the US session, given yesterday sharp intraday rally. All right, so the first support level to watch will be US session, the US session low, okay, which is 42,860 level, 42,860 level over here. Okay, so below 42,860 potentially exposes the 200-day moving average and the 20-day moving average confluencing at the next graphical near-term support zone at 42,650, 42,480. However, if price action didn't actually stage that minor pullback and continue to squeeze up above 43,290, then I got to respect the bullish impulsive price action for it to continue to see the impulsive bullish up move sequence, exposing the next resistance level at 43,740, which confluence with the one-time Fibo extension from the low of 23rd of May, and the 43,740 also coincide with the minor congestion area of 3rd of March as well. Okay, so that's for the US Wall Street 30. Next up will be the SPX 500. So the SPX 500 also squeeze up over here and now also almost hit the upper limit of this potential ascending wedge configuration as well at 6,126 level. And this 6,126 level also confluence with the 0.618 Fibo extension taken from the low of 23rd of May. And what's interesting over here is that the hourly RSI for the SPX 500 has shaped a bearish divergence. All right, a bearish divergence over here. Okay, so increasing the odds of at least some form of a minor pullback that potentially could be seen at the start of the European session heading into the US session after that very strong vertical impulsive up move that is being seen yesterday throughout yesterday's session. All right, over here. And using 61,126 as my short-term pivotal resistance level, we will have a bearish bias for a potential minor corrective pullback to take shape on the SPX 500 to retrace yesterday's steep up move. First support level to watch will be yesterday's US session low over here at 6,070. 070. A breakdown below 6,070 exposes the next support zone at 6,050, 6,030, and below it sees 6,005, which is very close to the psychological level of 6,000, and as well as the pullback support of this former minor descending resistance. However, if price action starts to stage a bullish breakout above 6,126, then I got to respect the impulsive upmove sequence that may continue to extend throughout today as well, today's session as well, heading up towards the current all-time high level at 6,151. Above it may see 6,171, which is the 0.764 Fibo extension taken from the low of 23rd of May. So that's for the US Wall Street 30. Not that's for the SPX 500, pardon me, a bit of tongue twisting. So that's for the SPX 500, flipping to a bearish bias stance for a potential minor corrective pullback today, retracing yesterday's steep impulsive up move using 6,126 as my short-term pivotal resistance level. On the Nasdaq 100, very quickly, so Nasdaq 100 hit our resistance level, which is the all-time high area at 2,200, 2,250 that we highlighted yesterday. And also seems to me that it's also the upper limit of this minor ascending wedge configuration from the low of 23rd of May over here. So the hourly RSI also has started to shape a bearish divergence as well, indicating a increased probability that after yesterday's steep impulsive up move, there could be a risk of a retracement, kicking start a minor corrective decline in first step for the Nasdaq 100. So with this imminent corrective pullback that could take shape because of that increase by the odds by that bearish divergence that's being seen on the hourly RSI right now, we'll be flipping to a bearish bias stance as well on the Nasdaq 100 using 2,250 as my short-term pivotal resistance level, which is the all-time high area. First support level to watch will be yesterday's US session low. Over here at 2,065 level over here. 2,065, first support level to watch. A breakdown below 2,065 exposes 21,990, which is the former minor swing high area of 17th of June and 20th of June, and below it sees the 20-day moving average at 21,750. However, if price action starts to do a bullish breakout above 22,250, then I got to respect this impulsive up move sequence to extend for the next resistance zone to come in at 22,420, 22,520, defined by the 0.674 Fibo extension and the 2 times Fibo extension from the low of 19th of June. So it's a Fibo extension cluster zone over here. So watching 22,250 short-term pivotal resistance for today, which is the all-time high on the Nasdaq 100. Flip to a bearish bias stance for a potential minor corrective pullback that may take hold today on the Nasdaq 100 after the very sharp impulsive up move that was being seen yesterday. So that sum up the intraday technical outlook on the major stock indices. Let us now turn our focus quickly to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, yesterday we were neutral. So price action broke below 3,346, hit the next support zone at 3,321, 3,300 level. And now price action managed to reintegrate back above the 50-day moving average. So with this reintegration back above the 50-day moving average after yesterday's intraday breakdown, that may constitute a start of a bullish reversal on gold XAU/USD. And given that the dollar weakness continues to persist for today, as I covered in the intraday technical outlook on the major US dollar pair. So with that, I will flip back to a bullish bias on gold XAU/USD using 3,300 as my short-term pivotal support level. Two intraday resistance level to watch for today will be 3,346, which is the 20-day moving average. Above 3,346 may revisit 3,400, which is a stubborn resistance level that the gold can't break since Tuesday, 17th of June. However, if price action starts to break down below 3,300, then that would invalidate today's intraday bullish bias. So we'll continue to see the corrective decline sequence extending further to the downside, exposing the medium-term ascending trend line, confluencing with the graphical support zone of 3,270, 3,250 next. All right, so that's for gold XAU/USD. Flipping to a bullish bias stance for today using 3,300 as my short-term pivotal support level. Next up, lastly, will be the West Texas oil over here. So the West Texas oil continues to actually trended downwards over here. All right, so upon toiling downwards, it also broke below our short-term pivotal support yesterday at 66.20. So given that element are rather mixed right now, because we do have a bullish divergence that's being seen on the hourly RSI, indicating that the sell-off that has taken shape since this Monday after the conclusion of that Iran-Israel ceasefire that potentially could actually end this 12-day of hostility between these two countries. Oil prices continues to dwindle down because there is now lower risk of the Strait of Hormuz being disrupted. But however, with a bullish divergence that's being seen on the hourly RSI, so this causes a mixed element. So I will actually flip to a neutrality stance for today. So neutral between the 50-day moving average at 64.05 over here. And the upper limit will be the 200-day moving average, acting as the resistance zone and also the former descending resistance from 28th of September 2023 high that's got reintegrate back to the downside again. So this will be my upper neutrality limit. All right, so neutral between 64.05 and 69.15/70. So only a break up or bullish breakout above 70.60 will revive back the boost to expose 73.60. All right, so flipping to a neutrality stance for today between 64.05 and 69.15/70.60 on West Texas oil. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So today will be Wednesday. So Wednesday at the start of the European session, pretty much quiet, nothing to take note of. So the action will come at 10 p.m. Singapore time, where Fed Chair Powell developed his second day of testimony to Congress. So this time will be the Senate. So very likely there will be no news speeches. So pretty much similar with the speech that he delivered yesterday to the House. Then thereafter at 10:30 p.m. will be the weekly EIA crude oil stockpile change that could influence the short-term movement on West Texas oil. That will be at 10:30 p.m. Singapore time. And with that, yeah, that will be a rather quiet US session as well. So news flow will be more pertaining to any news flow that's related to Israel and Iran, whether to see the ceasefire continues to hold. All right, for today. So with that, that sum up today's Daily Dose of Market Insights. I'm Kelvin here, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.